So this webinar is sort of the seven most common and costly pitfalls or mistakes that small and mid-sized enterprises are making. We're really focusing on the accounting and tax side. So if you are live today, you can drop all your Q&A questions into that Q&A section in the Zoom call, and then we'll go back and look at those at the end. If you're here on YouTube, there's going to be some links and contact info in the description, so you can reach out to us if you have questions. The format today is about 20 minutes, maybe 25 minutes of content, and then we'll go into the Q&A session and we'll try to get a few of those questions in as long as we have some time. Our goal is that you'll leave here with some risks to look out for and also knowing sort of who to call and who to reach out to if you are having some of these problems. Overall, we're going over some general information, so it's really not specific to a situation. We want to give you some things to look at, but if you have a specific situation with specific facts, you'll need to book a meeting to follow up on that. We can't go over detailed specific facts in this session. So just a quick introduction of Megan and myself. So I'm Robin. I'm a partner here at HW Partners in Ottawa. I specialize in assurance services and tax, working primarily with owner-managed businesses and entrepreneurs across quite a range of industries. So Megan, I'll pass it off for you to introduce yourself.
Thank you. My name is Megan Wallace, and I'm a lawyer in the business law group here at Mann Lawyers. I work, as Robin does, with small and medium-sized enterprises, as well as other aspects of my practice, including larger businesses and not-for-profits and charities. And I'm really happy to be here with you all to help take you through these points about how best to avoid these pitfalls and protect yourself.
Thank you, Megan. So HW Partners and Mann Lawyers, we work really closely together on quite a few clients. Often we find that the accounting and legal issues are intertwined, so it's good to have a team that really does work together. So today's content, we're really focusing on things that Megan and I have seen in real life. We see weekly. It's not theoretical problems. These are things that business owners are facing today. So all seven of the mistakes that we're going through are fully avoidable. They're also fixable, but most owners are sort of facing these and dealing with this the hard way of dealing with these problems and having to fix them. What we want to see is that you're identifying them in advance. It's a lot cheaper and a less of a headache if you sort of plan to deal with these rather than going back and trying to fix them afterwards. So the costs that we're looking at trying to avoid are CRA reassessments, denying deductions, lawsuits, unnecessary tax. And as we go through these items, don't get too scared of sort of these consequences, but I really would encourage you to ask yourself, is this me? Is this going to be me in the next few months? And do I need to set up a call? So I'm going to start off with a couple of sort of the accounting side. Megan's going to sort of chime in if there's a legal aspect of that, and then we'll go into sort of the more legal heavy items and sort of finish off there. So the first one that we see is HST registration and remittances. The HST world is quite complex. And so the first thing that I want to identify is the threshold of when HST applies to you. So when you meet $30,000 of worldwide taxable revenues over $30,000 over 4 consecutive calendar quarters, a mouthful, that 4 consecutive calendar quarters is a rolling 4 quarters. So not necessarily a year, but it rolls forward. So you have to keep an eye out for this all the time. Then you have to register for HST. That registration should happen within 30 days of the point that you cross that 30,000. And I do want to point out that this threshold applies whether you're a sole proprietor or whether you've incorporated. So any sort of business as soon as you meet that 30,000. So the first issue that we see with HST is that individuals or businesses haven't registered or they failed to collect the HST. So CRA determines CRA might come back and determine that you should have registered or you should have collected HST on amounts that are not collected, and then you're on the hook for that HST even if you haven't collected it on revenues. So then there would also be interest and penalties on all of that HST, so it does add up. Most clients that we see, there are a couple of exceptions, but most clients can't recover that HST from clients. Either there's a lot of customers that you're dealing with, you can't go back to all of them, or it might damage your relationship with a good customer, and you don't want to go back and ask for that extra HST. I wanted to go through a numerical example just to show the impact of this. Let's say you typically make about 30,000, you've just reached that $32,000 of income over 4 quarters, and you didn't register, you didn't notice that you went over that threshold. CRA might come back a year, more than a year later. They've started to notice that on your tax returns, you're over 30,000, and they've assessed now. You have to go back and pay that HST. Just in that 1 year period, you're going to owe $4,000 plus the interest and penalties. So 4,000 on 32,000, that's a huge amount of somebody's income. You can see how this small oversight adds up very, very quickly. The next thing that we see, and Megan and I were saying we see this quite often, unfortunately, is that the money collected on the HST ends up being spent. So all of this HST is being collected on behalf of CRA and then remitted to CRA. None of it actually belongs to the business owner. You're holding it in trust. What happens is that people will accidentally spend the money on regular business expenses, and the money is gone by the time they're actually filing their HST return. This can be a big problem because you're still on the hook for that. You still owe it to CRA. So what I would recommend is always trying to keep this HST portion separate, at least in your mind, maybe even in a separate bank account, or sending remittances off to CRA on a regular basis so it's not sitting in that account sort of burning a hole in your pocket.
Absolutely. And I wanted to chime in on this one because when I see this from my perspective, it's often in the context of liability of a director or a sole proprietor, simply because HST is a liability that does not just rest with your business. If you're a sole proprietor, it rests with you because you are your business. And if you're a corporation, directors can be personally liable for HST if the corporation doesn't pay. So I've had folks come in where money got short, and so they stopped paying the HST remittances, and then the board all of a sudden realizes that they have this quite significant financial liability, and it's CRA is unrelenting in its pursuit of HST. So it's not something that is going to be forgotten about. They're going to find out who the directors are from the public record, and then you're going to start getting letters personally. So this is a critical one that can be extremely expensive for those involved in the business.
Absolutely. So one other aspect of the HST that I wanted to bring up is there are also really good planning opportunities that are missed. So one of those is input tax credit. So this is HST paid on expenses that you can actually recover, and it reduces your HST liability. When you're starting a business, maybe you're just about to incorporate or you're starting a big project, there might be startup costs, equipment, incorporation fees that all have HST on them that you can recover. So by voluntarily electing to register for your HST early, you might be able to recover some of those input tax credits, and you might be in a cash positive situation by registering early. As soon as you register, you do need to start collecting that HST on income, even if you haven't met the $30,000 threshold. The other one is the quick method of calculating HST. This is an election you can make with CRA to do a simplified calculation of HST. Instead of 13%, we're looking at about 8.8%, and CRA's made an assumption about the expenses that you're incurring. This can be a huge benefit for low-cost businesses, someone like a consultant, which we see a lot in Ottawa. If your expenses are quite low, this again can be a net positive election where you're saving a bit of tax. So I want to emphasize that reaching the $30,000 threshold is a bit late for giving us a call. Try to give us a call if you think you may be trending towards 30,000 or some of these expenses are coming up in the future. Moving on to the next mistake here, we've got mixing personal and business expenses. This is very common. We see this with a lot of businesses, and it's quite easy to make this mistake. We hear a lot of the points that I'm getting on my business credit card are really good, so I want to use my business credit card for everything. But then we get all of these personal and business expenses all mixed up together. So the first issue that comes up with all these mixed expenses are when the personal expenses are going through the business, how do we tell what's business and what's personal? Can we really trust the books? Do we understand what our expenses are? And do we know if we're actually profitable in our business? So the books become inaccurate and really difficult to read. When your accountant comes in at the end of the year, then they might have to do a lot more work to figure out what is an actual business expense, what's personal, sorting through everything that's going in there. It can be a real mess and it can be quite costly to fix that. We also see that there's a much higher chance of errors, of things being expensed in a business that aren't actually business expenses. If you don't exclude those and there are mistakes that get through, CRA might start flagging your account for errors that they've seen, inaccurate records, and you might have a lot higher CRA scrutiny, more audits, more reviews. It can be quite costly. On the other side, if you're paying for business expenses personally, we often see that people are missing their expenses. They are paying for things throughout the year. If this happens sort of a one-off, it's not a big deal. You reimburse yourself, you document that, record it in the business. The problem is when it happens a lot. By the time you get to the end of the year, you may have forgotten about expenses that you incurred for the business and you're not getting that deduction. You may also miss it when you're calculating your HST for input tax credits and end up paying more HST. The other thing is if you have denied expenses because these invoices might be in your personal name. So if it's not in the business name, it's in your personal, and CRA ends up looking at it, they can deny that because it's not related to the business. One more thing that I've been seeing quite often is that you might have personal items that are going through the credit card or going through the business account and not realizing how quickly they accumulate during the year. When anything that's going personal through the business is considered a draw out by the shareholder. So that is taxed in your personal hands. By not realizing sort of how these accumulating through the year, when you go to calculate how much you've taken out of the business at the end of the year, it might be quite a shock of how much you've spent in the business by not realizing. And then you have this big tax balance at the end. So we don't want those surprises. We want everything really documented and kept separate if at all possible. The fix on this is very easy. Open your business account for your bank account, open your business account for your credit card, and try to keep things very separate. Keep receipts and make sure that they're in the business name. And then if you need personal funds, take those out as a salary or as a dividend first, and then pay for those personal expenses. That flows really nicely into our next mistake, which is suboptimal owner compensation. So when you do have this excess cash, things are going well, you want to start remunerating yourself either through salary or dividends. Thanks to tax integration, the system is really designed so either way, you're going to be paying about the same amount of tax. And so the decision making really goes into other factors that go into salary or dividends. Salary generates RSP room and also builds CPP credits, and it's deductible in the corporation. However, it does take a much higher level of administration. There has to be payroll remittances monthly, and there are steep CRA penalties if you're late on any of those remittances. Dividends are quite a bit more simple. You can take dividends out anytime throughout the year. It doesn't add to your CPP or RSP room, but they're quite flexible. The issue here is that you're not sending that remittance in throughout the year, so there can be a surprise tax balance at the end when you calculate your personal income taxes. Typically, what we see is a combination of these is actually the best. The mistake that we often see in businesses is this default trap, where somebody chooses a remuneration system, they either choose dividends or salary, and then they just stick with it for years. The optimal mix of these remunerations really changes year to year. So your RSP room might change. You might have other income sources or other cash flow sources. You might have family involved in the business. It can really change year to year, and choosing the best combination is going to save you quite a bit in tax. I do want to note that if you are paying family members, there are TOSI or split income rules to consider. So that's a good time to call your accountant and make sure that you're on side with those rules. The key fix for this is doing an annual review. looking at what the optimal combination is of these two remuneration styles, and really talking with your accountant about what's the most tax efficient way to take money out of your business. The next one is operating as a sole proprietor too long. Do I incorporate or do I not incorporate? Most businesses start as a sole proprietorship. It's just you as a business being taxed on your personal tax return. It's very easy and cheap to do that, and that's not a problem. The mistake isn't starting there, it's staying in that position too long and not incorporating. So I'll go over a bit of the tax side of this, and then I'm going to hand it over to Megan to look at the legal piece. So there are three factors to look at when you're deciding whether you should incorporate: profits that you don't need to take out personally that you want to reinvest, exiting on the horizon, so selling of the business, and then liability exposure. We'll talk a little bit about exiting and selling the business a little bit later on in mistake number 7. So I'll focus right now on extra profits, and then Megan's going to look at the liability exposure. So as a sole proprietor, you're being taxed on full personal tax rates. Any money in the business is being taxed at your regular rates up to 53%. In a CCPC or a corporation, you're paying tax at about 12.2%, a large differential in the tax rates. If you're leaving that money in the corporation and only being taxed at that 12%, you're able to reinvest that extra tax you would have paid into the business until you take the cash out in the future. That is a great way to grow your business. Most of the time, that sort of sweet spot is when you reach about $75,000 to $125,000 of profits that would be reinvested in the business. I do want to emphasize this is a numerical exercise, so this is one factor that you're going to consider, and liability exposure, which Megan's going to talk about, really might bring this timeline up earlier. So Megan, I'll pass it off to you.
Thank you. This is one of those interesting issues where the lawyers and the accountants have different thresholds for when incorporation makes sense. What a corporation does is it creates a legal person. So that legal person is where you rest all the liability. So a corporation stands between you as the business owner and outside liabilities. So among the reasons corporate lawyers like corporations, that's really the big one, is it protects the people involved, because most of the corporate liabilities, we talked about HST before, which is a little different, but the vast majority of corporate liabilities don't flow to the directors and the shareholders. So for example, if you're signing a lease, if you are entering into a significant contract, things like that, if you do so as a sole proprietorship, you are personally liable to the extent of all of your assets for any of those corporate obligations. Whereas if a corporation signs those documents or enters into those arrangements, the shareholders and the directors of that corporation will not have personal liability. So it is a way to protect what you have personally and keep it separate from the risks that may be associated with your business. So when someone comes to a corporate lawyer and says, well, I'm starting a business, one of the first things we actually bring up is incorporation, regardless of income, so that you have that protection moving forward. And so that as you go forward and sign contracts and things like that, you do it in the corporate name to protect your personal liability. So our next next mistake is no corporate records. And I actually have a couple of these on my desk right now. What we mean by corporate records is the documents that reflect the choices you've made about the corporation. Some folks incorporate online, and then you only get articles of incorporation, but that's a very small part of the piece. So your full corporate records, you may have a big maroon binder that slides into a maroon case. That's called a minute book, and that's what corporate records are often referred to as. So in addition to your articles of incorporation, you would have your bylaws that set out some certain governance requirements. You'd have resolutions of the board and the shareholders approving things like entering into contracts. And part of putting a corporation together is actually issuing the shares. If you just have articles of incorporation and you've never done any of the documentation to establish what the corporation looks like, you're not a shareholder because no shares have been issued. And I think Robin and I were talking about this the other day, where sometimes you have someone come in and they say, well, I'm a shareholder, I'd like to give myself a dividend. And then you look at the corporate records and you say, okay, well, you've never told anybody you're a shareholder. There's no documentation of this. And these are maintained on an ongoing basis. So every year, you should be completing either minutes of an annual meeting or resolutions of an annual meeting, because there are approvals that need to happen every year. Sometimes we have folks come in and they're ready to sell their business and they haven't updated their corporate records in 20 or 30 years. And as you might imagine, going back and then trying to figure out everything that happened at every different point and who was in charge when can be quite complicated. And it's very rare that after that length of time, you can actually recreate the records. Someone's left the business, someone's passed on. So there are remedies in that case. We can create a resolution that basically says everything that's happened before is approved. But this is an issue when you're trying to sell your business. So if we're selling your business and we bring the corporate records to the lawyer on the other side of the transaction and they see that things haven't been well maintained, it creates an area of risk for the buyer. So that's context where you can be asked to give an indemnification, which means if there's any errors or anyone comes back, you would have to pay for it, or they could try to negotiate a reduction in your purchase price. So it is something that an ounce of prevention is worth a pound of cure. In this case, it's relatively straightforward to keep on top of this on an annual basis. It's a service that law firms do provide. And even beyond that, when you make a decision as a corporation, the board of directors would decide to enter into a contract or something like that. There needs to be a document reflecting that you include in your corporate records. So similar to that is our next mistake, which is not having a shareholders agreement. Now, a shareholders agreement is an agreement between the shareholders of the corporation and the corporation about how they're going to do things. And this contains a lot of the details about the relationship the shareholders are going to have to each other. The bylaws and the legislation that governs the corporation will have some of those rules, but the default rules in those documents are not sufficient to appropriately plan for your business and the things that might happen. So things like death, disability, if someone wants to exit the corporation without a shareholders agreement, there may be no mechanism for how shares are valued, what that transaction looks like. And I've seen situations where there have been shareholders, the relationship has come apart, but neither are willing to buy each other out, or neither are willing to sell, and then everyone's stuck because there's no agreement as to what that would look like. So the best time to figure out what all those things that might go wrong are going to look like is when things are really going well at the beginning and you're setting up. It's way easier to have a conversation in theory about these things. And I would, as the slide says, where there isn't an agreement that sets out what's going to happen, that's a situation where you run into litigation, which is expensive, emotionally taxing, and might not get you the result you're looking for. So this is something I very strongly recommend, even where you are operating within a family. So that you might be in business with your family or with close friends. It's even more important then, because an agreement like this can help preserve the relationship down the road if the business doesn't go well. So
I would say especially important in a family relationship.
yeah, absolutely. Because if we've already decided on what the rules are, then there's no need to have a fight later on. And I appreciate families more complicated than that, but this is again an ounce of prevention, pound of cure situation. Our next mistake is it's two mistakes really, two in one: misclassifying workers and weak contracts. So it's very common for us to get calls at my office saying, okay, I'm hiring an independent contractor and we have to make sure that the contract says independent contractor, so CRA will understand they're an independent contractor. And the reality is that what the contract says has very little to do with what CRA is going to consider in terms of whether that individual is an independent contractor or an employee. And the reason it matters is because with employees, you're obligated as a business to be paying certain remittances, to be registered for certain programs, whereas with an independent contractor, you're not. So in terms of how to determine whether somebody is an independent contractor or an employee, there's a set of indicia that CRA uses. You can see them on the slide. So one of them is control. As the employer, as the business owner, are you in charge of what I do every minute of every day, or do I perform my tasks somewhere else and report to you intermittently? We also have how many hours you're working. If you're working 40 hours a week for one business, you're probably not an independent contractor. A lot of people would argue there's more factors there. Also, ownership of the tools you use if you're supplying those to your staff, and chance of profit and risk of loss. So this is something that's important to get in front of. So before you're entering into that relationship with a staff person, you want to speak to somebody to make sure it is clear whether they're a contractor or an employee, so you can make the appropriate payments if they're an employee and not have CRA come back to you in the future to ask for those payments, which is what will happen. And again, because we're talking about CRA funds, we are talking about personal liability for directors generally. And weak contracts is another key one. Generally, I would describe a weak contract as one that has a lack of clarity, doesn't have the kind of requirements of form you might expect. It might be unsigned, it might be undated, but particularly it's one that doesn't explain the relationships that the parties are going to have to each other. And it's very difficult to enforce a contract based on what you think as opposed to what's written down, because what matters is what's written down. If you've had a discussion before you entered into the contract and then you've signed a contract, all that previous discussion is excluded. And a court is not going to add in terms for you. So you really are stuck with the paper that you have. And if it's not clear what the obligations are to each other, when payment is due, what was supposed to be delivered in exchange for the contract, you will find yourself in a difficult situation trying to say, well, no, you promised me you were going to send me a 4-page report, but what you've sent me is 3 bullet points on a cocktail napkin. So I always say it's really important that the contract sets out everything that you hope to receive, that you plan to give, and all the terms and conditions around the relationship. So our next slide is, I'm going to start this one and then I'm going to pass it back to Robin. This is selling without planning the exit. And we were discussing this the other day, and both of us agreed that really it's best to start thinking three years out when you're going to sell, so you can start getting all those ducks in a row. What I find as someone who acts as corporate counsel doing transactions for purchases and sales of businesses is that often when folks come in with incomplete corporate records, poor employment agreements, lack of good contracts, during the due diligence phase of the transaction, which is when the buyer is going to look at all of your documents, try to find all of the skeletons and all of the warts in there, things not being in order delays the sale. And it can also result in someone who's purchasing coming back for you and saying, well, I want you to indemnify me or promise to pay me if there are any issues with this particular issue down the road. It also may result in them trying to negotiate a lower purchase price based on the fact that there are risks inherent with the corporate records or the employment agreements, for example. Robin, do you want to take it from here?
Absolutely. And so I love this 3-year runway that Megan's mentioned. One of the key things when you're planning a sale on the accounting side is the lifetime capital gains exemption. So every taxpayer has access to a $1.25 million pool of sales proceeds from small businesses being tax-free. So this is a really amazing thing that everyone has. If you have more than one shareholder in a business, this gets multiplied by the number of shareholders, but it only works if the corporate structure is set up properly for enough time. So there's a 24-month test that has to be met in a small business to say that this is an active business that's being operated. And so we need time to make sure that that 24 months has been on side of the rules. So giving us 3 years gives enough time to do any restructuring that might be needed, making any changes, taking out any passive assets, and then allowing this sort of 24-month timeline to begin so you can sell at that tax-free rate. we've had a lot of times where clients have come to us right before a deal goes through, and there's really not enough time to do the restructure and do any changes, and they really miss out on this huge taxable benefit. So, uh, best to get involved with your lawyer and your accountant early. Even when you're setting up a business, it's good to have these conversations. If your business is sellable, that might be a reason to incorporate and set up these tests and this structure so that down the road you're already ready to do a sale and get the tax-free benefit rather than being taxed at capital gains rates. And so that's our 7 big mistakes that Megan and I are seeing quite often. Hopefully, this has been a bit of an insight for you. And you can see that the accounting and the legal questions are so intertwined. There's a legal and accounting sort of points for each item. And it's best to handle them together. So HW Partners and Mann Lawyers, we work really closely on a lot of these issues for clients. It's really good to have this team involved to make sure that you're hitting all of the different aspects of an issue. If you're listening to this and any of these things sound familiar, please reach out. Let's have a conversation, see how we can either get ahead of it or fix it after the fact. You don't want to wait until CRA or legal action forces this conversation. On this last slide, we've sort of put a little bit of a checklist out here, just some questions to keep in mind for you to sort of trigger that maybe this is an issue and maybe you do need to have a more of a conversation. The recording is also going to have our contact information. So if you do have these issues and you want to reach out, you can reach out to Megan or myself. If you're not sure who to reach out to, no problem at all. Just reach out to one of us. We'll triage and make sure that you're in the right hands.
Absolutely.
Before we get to the Q&A session, I just wanted to thank Megan so much for being here and to giving your insight into the legal side of these issues. It's been really a joy to work with you.
Thank you, Robin. This has been great fun.
So now we will open the floor. We do have a couple of questions here. I will remind you that we are going to go through general questions. If something is really specific to the question asker, then we'll probably defer to an actual in-person meeting. So let's see what questions we have on here. One of the questions is, what do you need to have for a complete corporate record? Megan, did you want to look at that one?
Good question. So each incorporating statute, so the Canada Business Corporations Act or the Ontario Business Corporations Act has a list of what a corporation is required to keep. But the basics are that you should have the minute book or electronic book that has your articles of incorporation, your bylaw, your shareholders agreement. The shares should be properly issued, and you should have either minutes of meetings or resolutions that reflect the decisions that have been made throughout the life of the corporation. We also suggest that you keep things like when you file your annual return, you put that in the book. So it basically is the documentation of the life of the corporation, and on an ongoing basis, the decisions that are made, as well as a list of the directors, officers, and shareholders over time. So it would go back to the beginning, and then you would show dates when everybody came off and came on. So it's not an enormous list, but I find the part that people struggle with the most is the approvals, right? Because unless you have an instrument saying this person can approve contract, technically it should go to the board. A lot of people don't do that. So that's where I find the biggest gap often is the resolutions.
I would say most commonly what I'm seeing right now is not having a share register that's being issued. That one always scares me. And the shareholder agreement. Those are the two that I'm just right now, I think with a lot of the DIY online systems, they're not considering those two things, and they are critical. One thing I did want to bring up sort of with this share register, one issue that we've seen historically, and I think people are really catching on to this now, but a really small thing people can do to make sure that they're on side of the rules is when they're issuing shares, there actually needs to be a cash transfer to the business to purchase those shares. What we're seeing is that in the past, it might have just been sort of an accounting adjustment. We're recording these shares for $100 and we're putting it into a shareholder account. The shareholder owes the company, but it never actually gets transferred into the corporation. That is being flagged by CRA now and basically saying you didn't pay for the shares, so you don't own your own corporation. Really scary problem that could be fixed by just doing that quick transfer, actually putting that cash into the business. Makes a
Yeah.
huge difference.
Consideration or payment has to flow for a share to be issued. We often document this when we're starting a corporation. You're buying each share for $1 or each share for 10 cents. So it's not a big payment, but it's one of those really important boxes to check.
And Megan, do you commonly see this as like an e-transfer, or do you often see it as like cash? What would be most
You know what?
common?
I see it in all sorts of different ways. I think the key point is making sure that it gets in the corporation's bank account and you understand how it got there. So if you e-transfer it, I would probably make a copy of that, maybe attach it to my to the shareholder documents in the minute book. Um, and I mean, I think checks are becoming less and less common, but a lot of people do use checks for this simply so that there's a record they can go back to.
That's really great advice. The next question I've got here is I haven't met the HST threshold. Should I just get registered now and start charging the HST? That's a great question. One thing that I have seen is people will be nervous about reaching this $30,000 threshold, and so they will just get registered. And this question really hits the nail on the head. The really important part is that you start charging HST from that moment that you register. I did have a client recently that unfortunately they had done this. They were nervous about the threshold, got registered, but didn't notify us that they had registered. So they didn't charge HST for years. And then we had to go back and catch up, and it ended up costing them quite a bit of money. Um, we don't have a lot of wiggle room for that to sort of go back and fix it other than just paying the liability that's owed. So generally, I would say have the conversation about when are you going to meet the 30,000. We typically advise waiting until you meet that $30,000 threshold unless you have some ITCs to recover. But if you're feeling really nervous about it, it's okay to register early. Just make sure you start charging the HST. I think we might have time for another quick question on here. Let me just go
All
through and
right.
see if there's another. Here's a good one. So most of my team is on a contract or contractors. If CRA reclassified them as an employee, what would be my exposure? That's really the question here.
Yeah. Yeah. Well, the exposure could be it is likely going to be in the event of that reclassification, all of the payments you should have made because they were truly an employee and not a contractor. So depending on the number of individuals involved, the income level, that it can be significant. So in terms of cleaning it up and next steps, I think it's important to figure out whether they are or are not contractors or employees. And if they are truly employees but classified as contractors, I think what you're going to need to do is move them over to new contracts and start that employment relationship. I appreciate this can be a difficult one simply because some folks don't want to have those deductions taken off. They want to be an independent contractor, but um, the best way to protect yourself is to ensure that this is a clear line in the relationship, because they might want to be an independent contractor, but they might truly not be an independent contractor, and that's a risk to you that I would not suggest that you take.
That's right. I would say that being an employee is the safer option, while the contractor is often perceived as the cheaper version. And so I would argue against that just because the penalties are quite high from CRA for not making these payments. So, like Megan said, you're on the hook for any of the deductions that should have been taken. But those penalties really start hitting on a monthly basis for anything that wasn't remitted. So, it can often be cheaper just to go with the salary from the beginning if you're on the fence.
Agreed.
And I think that's all the time that we have today. So this was really great, Megan. Thank you again for joining me today. This has been really insightful and hopefully it was really helpful to our sort of participants and listeners today.
Yeah, thank you everyone for coming and for the great questions, and thank you, Robin.